Hello, everybody, and welcome back. So I don't know what I was thinking. I have delusions of grandeur sometimes that I can do it all. And this week it blew up in my face because I promised you a video on PPP forgiveness applications, but I just did not have the time to dedicate to them because, go figure, I was also working my way through a fairly significant tax deadline. So the taxes had to take priority and I was not able to dedicate that time. So I apologize, but bear with me. That video is coming. I just need to get through this tax deadline and I want to make sure that what I produce for you is easy to understand and a quality video. So it is coming. Remember, we have time. I want to make sure we do this right. So this week instead, I'm going to talk about some of the landmines that happen to many of my clients, especially if they're new clients and haven't received advice from me before in the past, that tend to create surprises for them when it comes to tax season. So hopefully I can't really help you for the 2019 tax season, but maybe you can sidestep some of these landmines for the 2020 tax season. It's in no particular order, but the first thing I want to talk about, because it's the one that I most commonly see, is simply not enough payroll taxes being taken from your paycheck. I do have clients who are not business owners who come to me for taxes every year, and they don't have that much going on. They may own a home, they may have a couple of children, but they're W-2 wage earners, and my demographic is about the middle to upper middle class wage earners, so just to keep that in mind. And in 2018, or for the 2018 tax season, many of those who had never owed taxes before owed between $3,000 and $5,000 when it was time for me to do their taxes. And let me tell you, that was an awful tax season. I was handing out a lot of bad news. But what had happened is that in 2018, as of January 1st, 2018, the new tax law had taken effect and it had changed how allowances were handled in the payroll system. So most of you may have noticed that your take-home pay increased and you never received a raise. And that's because fewer payroll taxes were actually being taken from your checks, and nobody noticed. Companies did not approach you with new W-4s because they didn't know that was the issue. So there was a lot of things that happened that still haven't necessarily been adjusted for the 2019 tax season. So if you're one of those people who doesn't have a lot going on for your taxes, you have a couple of 1099 INTs for interest from your bank, maybe you have a couple of W-2s, but you do not own a business and still manage to owe taxes at the end of the year, that might be one of the problems. So for my middle class wage earners, what I recommend is that they go back and take a look at their W-4. And if they're married and claiming 3 or 4, I recommend that they dial that down to married and claiming 2. Or if you're single, claim single and 0. Always claim single and 0 if you're single, unless you have a dependent, and then go ahead and claim 1. And then just keep making those adjustments. If you receive too much money back at the end of the year, go ahead, bump that allowance up 1 more. But if you continue to owe money, then you need to continue to dial back on that. And in some cases, there are people who are adding additional money. So they've dialed it down as far as they can go and are adding another $50 per paycheck to go towards state and federal employment taxes. So that is something that has been a big issue, and it continues to go around and around, and hopefully soon, in the next couple of years, it'll finally work its way out. Now, another thing that I see very often every year are people who have liquidated their qualified retirement plans because they needed the money or they left a company. And I can tell you, you do not want to do this without first speaking with a CPA. And the reason is most of them are doing it prematurely, which means they're not taking that money out when they're of retirement age. And so what happens is they get charged penalties for premature distribution. Okay, that's very important because a lot of people will do this liquidation and have them take federal and state income taxes out and think that they're fine. But it never, ever works out that way because 1, no matter what, they are never taking out enough in taxes. And number 2, they are not accommodating the penalties you're going to get hit with. And there are some reasons that this happens. First of all, the penalties are based on how much you liquidate early. And second of all, very often in terms of the taxes, it bumps you up a tax bracket. So you actually wind up owing more in taxes than what they took out. It's very, very important that 1, you talk to a CPA before doing so. 2, if you don't have to liquidate, roll it over into another qualified plan so that you don't have the tax impact. And 3, make sure you don't go spend all that money at once. Make sure you're putting aside some money for the anticipated penalties and additional taxes at the end of the year. This is something that I see so often, year in and year out, and I cannot tell you how important it is that you get professional advice when you are liquidating those retirement accounts. And just so you know what a qualified retirement account is, those are the accounts that you put money into pre-tax, meaning it reduced your taxable income so you didn't have to pay taxes on that income in that year. And these are also items that will be fully taxable once you distribute them. And if you distribute them early, it's not just taxable, there are penalties that go with it. So make sure you keep that in mind. All right, very often, here's another problem that I see, and if you are a business owner, you may have seen my last video regarding S-elections and how you can actually wind up paying taxes when your company took a loss. And that is because very often the S-election for my LLCs has not been taken properly. There is a right way, it's a great tool, but you don't want to take it too early. And sometimes I'll have people who've come in and they owe capital gains tax because they've taken an S-election, they didn't understand it, and their company suffered a huge loss, but then they drew money out of it. And there's this thing called basis or equity in your company that if it isn't calculated properly and you know what's going on, the money that you draw out can actually turn into taxable income. So that's another thing that I see often. So if you are a company who is considering an S-election or you have been recommended to take an S-election, please get a professional's advice and understand what it is that you're getting into. And I can tell you right now that if you are a company who suffers losses over multiple years, the S-election is not the right call. I don't know why I see this often, but very often I see somebody who's taken the S-election because somebody told them to, whether it is a peer or actually even other CPAs. They'll take the S-elections not really understanding what is happening, and then I have to explain it later. So just make sure that if it's brought up, you know exactly what you are getting yourself into. All right. Loss on your primary residence. Now, this is something also that I see a lot, where people sell their primary residence and it is a loss, but it doesn't actually have an impact on your taxes, okay? So what happens is you may sell your house for less than what you purchased it for, or you may have put a lot of work into it that increases the basis of the house and it generates a loss. Now, in many cases, I've seen people who thought that that was going to help reduce their tax liability at the end of the year, and then they'll go do something like liquidate a retirement account because they have the need for cash, but are somehow thinking that that loss is going to offset those taxes. And it absolutely does not affect your taxes at all if your house has a loss. Now, if you have a gain on the house, you may qualify for the capital gains exclusion on the sale of your primary residence, or you may actually owe capital gains tax if you're above a certain threshold. But when you take a loss on your primary residence, it does not offset other taxes. It does not reduce your tax liability or your taxable income at all. So make sure you keep that in mind and you don't do something in addition that may create a taxable effect. That is something I see often, way more often than I should. So I think it's because people do not understand that a loss on the sale of your primary residence does not offset taxes. All right, I think I've repeated myself enough on that one. All right, another thing that I see often, especially with my small business owners, well, exclusively with my small business owners, is deduction mistakes. Now, believe it or not, there are legitimate business expenses that are fine in terms of getting capital. So you can report it on your P&L, all of those fun things, but I cannot report it on your tax return, okay? An example of this is clothing. Unless it's branded with your company all over it, there are people who will buy clothing because they feel they need that clothing in order to do their job. And that is true to a point, and it may be a legitimate business expense, but again, unless it's branded with your company's name and you can't use it for any other use really, then I can't put that on your tax return. There are actually most meals are actually not deductible in terms, they are legitimate business expenses, but I cannot put them on your tax return. So there's a whole host of non-deductible expenses out there that people rely on in order to reduce their taxable income, and that just doesn't happen. And it's mostly because there's a lot of bad information out there. So make sure that you are talking to your CPAs, your tax professionals about what is and is not deductible so that you have a good understanding of those things. Now, I'm not saying don't spend money on those things. I'm not saying that at all. Just know that I can't put them on your tax return. All right. Now, the last thing I want to talk about, and it's something I've been working a lot with this year and certainly have in previous years, but it seems to be very heavy this year, is depreciation on your rental houses. So some of you own properties that you're renting out, and it is reported on something called a Schedule E, which is attached to your 1040, which is your individual tax return. And I have actually never seen a tax return come back to me where that has been calculated correctly if the property has been in service for multiple years. There's a lot of reasons that it happens. One, not understanding. Two, believe it or not, you can only depreciate the building, not the land, and that split isn't made, or it gets passed from accountant to accountant to accountant. And unfortunately, the attitude is, well, I probably won't be the accountant when this gets kicked down the road or sold, so we're not going to worry about it. But that depreciation is incredibly important, especially when it comes to selling the asset, because you get a tax benefit for that depreciation while you're renting it, but then the government takes that tax benefit back by having to recover it, to recoup it when you sell the asset. On top of that, there are carryover losses that we have to take into account if you have those. And so often when I get a client who has a Schedule E rental properties, I ask for all of the tax returns since when they started renting those properties if I can, so that I can rebuild it and make sure that I report it correctly on the tax return that I produce. So that's another thing that you need to really look out for, because in the end, when you sell that asset, it can have a tax impact, and we want to make sure that it's all reported correctly. All right, of course, I know that I didn't answer a whole lot of questions. I know that there are more about what you can deduct, what you can't deduct, who you should be talking to, and I think if you're going to make any major changes or decisions, you should definitely be talking to a CPA if you can. But please post your questions below. I will see what I can do to answer them, and it certainly gives me more video fodder, so I would appreciate it. I'd also appreciate it if you wouldn't mind following me on YouTube or Facebook or LinkedIn. I'm there across the board. And next week, I'm not sure what I'm going to be doing. I'm hoping PPP forgiveness, but I think I've learned my lesson to make those promises. So I'll see you next week. Take care. Have a great one.